Hi everyone. So welcome to the live stream today. Very much excited for having you on our revision month or into our revision month as we prepare for the ICMA 2021. I'm very much excited about this season because we have about 4 weeks to go for the ICMA 2021 examination, and we want to from now on focus on some key issues that we need to understand to position ourselves strategically to pass the examination. And this week we're going to be dedicating it a lot to financial reporting and corporate reporting, talking about the key standards that you need to understand in order for you to really pass the examination in that case. So I see some of you guys joining the stream. If you're watching and you know somebody doing financial reporting, corporate reporting, share the video with them, invite them, let them join the live stream, and let's see how we can reach as many students as possible. So give us a thumbs up on the video, share the video, let us reach as many students as possible. And in case you're watching on YouTube and you have not subscribed to the channel, also make sure you subscribe and click the bell notification icon. That way, when I go live, you'll be the first person to be notified, so you can join the live stream throughout this week as we continue with our discussion. Today, we are focusing on 4 key standards that are critical. That is IAS 16, property, plant, and equipment; IFRS 15, revenue from contract with customers; IAS 36, impairment of assets; and definitely looking at IAS 12, income tax. I'm looking at giving you a summary of all of these standards. Then we're going to be picking some questions and look at how these standards actually play out. Remember, the chief examiners for both financial reporting and corporate reporting have signaled that the critical issue about the standards for students, usually it's the application of the standards. So it is one thing to understand the standard, but it is another thing to know how to actually apply the standard. And that is exactly what I want to do with you in this session and in this series as we continue with our discussion. So I see some of you guys joining. You are welcome. Give us a thumbs up on the video on YouTube. Comment in the chat box. Let me know in the comment section where you are watching it from. If you have any questions, also put it in the comment and put it in the chat box. I would be answering all of them for you and assisting you in order for you to prepare well for the examination and, most importantly, pass the exam. So I see some comments coming in here from YouTube. Osmano Amankwa said, good evening, Mr. Nhyira. Good evening, Osmano. I hope that you're doing well. Joyce Nketia said, good evening, sir. Good evening, Joyce. I hope that you're doing well. Isaac Zulu said, good evening. I'm watching from Zambia, right, Isaac? But Anjum said, good evening, Nhyira Premium. Good evening, Bart. I hope that you are doing well, and welcome to the live stream today. So like I said, we're looking at 4 key standards today: IAS 16, IAS 12, IFRS 15, and IAS 36. You ready? So let me share my screen with you and let's get into the discussion real quick. Kweku Ban, I see you. You are welcome to the stream. So let me share my screen with you and let's get into the discussion real quick. So if you know somebody who has to be part of the live stream, share the video with them and let us reach as many students as possible joining the live stream or watching the playback. So together we can assist as many students as possible, helping them to be able to pass the examination. Right, so my screen is up. Let's get going and let's begin with the discussion for the day. Let's begin with the discussion for the day. So 4 key standards I want to walk you through today, giving you the summary principles of all of these standards. And most importantly, we taking a question to see how we can apply the principles relating to these standards. So we're looking at accounting standards. We're looking at IAS 16, property, plant, and equipment; IAS 12, income taxes; IFRS 15, revenue from contract with customers; and IAS 36, impairment of assets. Very critical standards in the exam. So whether you like it or not, IAS 12 is in the exam hall. It's going to really be there for you in the exam hall. IAS 16, it's going to be there waiting for you in the exam hall. So these are really critical standards that you need to understand in that case. So what do we mean here in relation to that? So let's begin the journey with the key principles when it comes to IAS 16, property, plant, and equipment. Property, plant, and equipment. Now, so when it comes to IAS 16 property, plant and equipment, there are a number of things that we need to understand about this standard. Now, when you pick any standard or each standard you pick, like I tell you all the time, there are key issues you need to understand. Number one is to understand the objective of the standard. What is the objective of the standard at the end of the day? Why was the standard developed? What is the standard trying to achieve at the end of the day? So the objective of the standard is very important. Along with the objective is the scope of the standard. What exactly the standard is covering as it is issued in that case. So the scope of the objective of the standard is something you must know, something that is very critical in relation to that. After looking at the objective and then the scope of the standard, the next thing you want to look at is the recognition criteria. The recognition criteria. Recognition criteria. Then you come to the issue in relation to the initial measurement. Initial measurement. Then you come to subsequent measurement. Then the last thing is going to be any disclosure requirements. The fun part is that the examiner can come from any aspect of these things that I've just listed. The objective of the standard, the scope of the standard, the recognition criteria, the initial measurement, the subsequent measurement, and then the disclosure requirements. The examiner can come from any of these angles when it comes to the standard, and it's very critical for you to know each of them in that case. In a nutshell, when it comes to IAS 16, it's a standard developed to account for non-current assets used, owner-occupied non-current assets. So you see, when it comes to non-current assets, depending on the way we account for them, we have the tangible non-current assets. Stay with me carefully here because I'm just beginning to bring out the principles in that case. So we have the tangible non-current assets, and then we have the intangible non-current assets. Usually, when it comes to the intangible non-current asset, that is where IAS 38 comes in, intangible assets. And we're going to be accounting for that, seeing what exactly we need to look out for later on. But our focus here is to look at the tangible non-current assets. When it comes to tangible non-current assets, they can also be categorized into two. We have what we call the owner-occupied non-current asset, and then the non-owner occupied non-current assets. Now, note that as per the conceptual framework, you must understand a couple of terminologies when you are dealing with the accounting standards in general. These terminologies include what is an asset, what is a liability, what's an expenses, what is an income. I'm not going to be going through all of them, but I'll just share my thought with you on assets. In a simple language, we say that assets are resources controlled by an organization as a result of past events from which future economic benefit flows to the entity. So the key word here is control. Control. So once the entity controls the asset, now when we say the entity controls the assets, it means that the entity directs the usage of the assets, and it also means that the entity significantly receives the future economic benefit or service potential in the assets at the end of the day. So assets are resources controlled by an entity as a result of past events from which future economic benefit flows to the entity. And we are saying that the key word in that definition is control. How do we determine control? We determine control by asking, does the entity direct the usage of the assets, and significantly, is the future economic benefit or service potential in the asset flowing to the entity? If we can answer as yes, then the asset or the transaction is treated as an asset in that case. Now, so when it comes to the tangible assets, There are two ways: owner-occupied and non-owner-occupied. When we say owner-occupied tangible assets, we mean these are the tangible assets that are used in the day-to-day running of the organization. So these are used in the day-to-day running of the organization. Now, the company could be using this asset for administrative purposes. They could be using this asset for manufacturing or as a factory facility, or they could be using the assets for any part of their business operations. Why is that important? Because if the entity is using the asset for the day-to-day running as an administration or whatever it is, then we need to account for the assets in accordance with IAS 16, property, plants and equipment. Property, plants and equipment. Now, if the company controls the assets, however, the asset is not being used for the day-to-day running of the organization. Instead, the entity either leases out the assets or the entity is not using the asset for anything, then that will be a non-occupied, non-current asset. So non-owner occupied non-current asset. This one, the entity doesn't use it in the day-to-day running, but the entity maybe leases it out or hold it for rental purposes, or the entity is just holding on it for capital appreciation. In that case, that means that the asset will be accounted for in accordance with IAS 40 investment property. So you realize that even though we are just sharing our thoughts on the non-current assets, you realize that so far we have three standards coming in. So when it comes to non-current assets in general, that is the overview that you need to understand. Then let me walk you through real quick on the IAS 16 property, plant and equipment, which is where our focus is today. Like I said, these are the assets that are used, that are controlled by an entity and are used in the day-to-day running of the organization, or are as part of the assets used by the organization for its operation purposes. Now, the first thing we need to talk about is what is the recognition criteria for this? To be recognized as an owner-occupied asset, number one, the definition of the asset should be met. So the transaction must meet the definition of an asset. It must meet the definition of an asset, which is resources controlled by an entity as a result of past events from which future economic benefit flows to the entity. Not only that, the cost of the asset should be reliably measured. The cost of the asset should be reliably measured. Not only that, now we will come back to some of these things in a moment. Not only that, it is probable that future economic benefits or service potential, it is probable that future economic benefits or service potential in the asset will flow to the entity. Will flow to the entity. So the definition of assets should be met. The cost should be reliably measured. It should be probable that the future economic benefits or service potential in the asset will flow to the entity in relation to that. Then, so the definition must be the cost shall be reliably measured. It is probable that the future economic benefits shall flow to the entity. So that is our recognition criteria. For us to recognize a transaction as part of our assets under IAS 16, we have to meet this recognition criteria. Then the big question comes in: what shall be the initial measurement of these? So the initial measurement. IAS 16 states that assets should be initially measured at their initial cost. In other words, the initial cost of a PPE, of property, plant, and equipment, shall be the purchases cost and all other costs incurred in bringing the assets to its present use. In bringing the assets to its present use. What does that mean? It means that we're going to be taking into consideration various issues like import duties, various issues like delivery cost, various issues such as the issue in relation to installation cost, dismantling cost. All of these things will be considered in the initial cost of the assets. So initial measurements, non-current assets are initially measured at the purchases price or the cost of manufacturing plus all other costs incurred in bringing the assets to its present use. So the purchases or manufacturing cost, and then other directly attributable costs. Other directly attributable cost. That is what gives us the initial cost of the assets. Now, this other directly attributable cost you see here could mean a lot of things. That is what I listed a moment ago. It could be an import duty we are paying. It could be delivery cost. It could be issues in relation to installation. It could be issues in relation to dismantling or environmental cost, EC for environmental cost, or it could be borrowing cost. It could be borrowing cost. So you realize that, again, even though you are dealing with IAS 16, there is IAS 23 there, borrowing cost, and there is IAS 37 here, dealing with dismantling cost and then environmental cost. And that is the beauty of accounting standards. You don't learn them in isolation. They are interconnected. So the way you increase your chances of really understanding the standard is to find out the relationship that exists between them. Because if a company borrows money to manufacture an asset, then the borrowing cost or the interest expenses on the loan would have to be included in the initial cost of the asset as per IAS 23. Also, where the entity has a contract to restore the environment, do landscaping, or dismantle the assets at the end of its useful life, in accordance with IAS 37, we have to make provision for it. How do we do that? By discounting it into present terms and then including it in the initial cost of the asset. So again, you're just looking at IAS 16, but you realize that IAS 23 is in town and IAS 37 is in town, and you must know when they are coming up and how we treat them in the transaction. So that is the initial measurement of the assets. That is the initial measurement of the assets. Now, I see some of you guys joining the stream. You are welcome to the stream. This is our IFRS masterclass where I am going through the summary of the standards with you, and also we'll be picking a question with you in a moment on the standards. And throughout this week, that is what we're going to be doing for corporate reporting and financial reporting students. I see some of you guys joining on YouTube as well as on Facebook. Give us a thumbs up on the video when you join. It helps us a lot to make the video more engaging so YouTube and Facebook can push it. Then also comment in the chat box. Let me know any questions you have for me. And if you have, I explained something you don't understand, please put it in the chat box or in the comment box, and I'll be glad to reply to you. Thank you very much for the thumbs up. Some people have given us some thumbs up on YouTube. Thank you very much. We really, really appreciate it because it helps us to grow the channel so we can reach many students just like yourself and also assist them to become more successful and pass their exams, because hey, financial reporting and corporate reporting, accounting standards in general is really a headache. John Malongo said from Tanzania, said, can you explain the difference between IAS and IFRS? It's simple. The IAS and IFRS are all accounting standards. However, the IASs are the initial standards. The IFRSs are the new standards that are being issued currently, and usually some of the IASs, some of the IFRSs are actually replacing some old standards. So previously you were having IAS 17, that is leases, but now it is replaced with IFRS 16 leases in relation to that. So they are all accounting standards, but the IASs are the old ones with the standards, and the IFRSs are the new modified one, which are issued to form with especially the USA standards, and also to be able to bring the accounting standards with that of the US, so that we have that uniformity. So the International Accounting Standard Board and the other institutions are finding ways to be able to bring a unity between the accounting standards in general. So the new standards that are being issued to sort of try to conform with the American standards, it's what is coming up with the IFRSs in that case. Apieje Kweku said, hi, Nhyira. Hope you are good. Yes, I'm flourishing. Eugene Inegu said, hi, from Kenya. Getting it well. Okay, that is awesome. Joycelyn Asoba, as I see you. You are welcome, Joycelyn. Thank you for joining us. And thank you guys. I love you guys so much. Thank you for the thumbs up on the video. We really appreciate it. It helps us a lot, and it pushes the channel so we can reach as many students as possible. Remember, we want to grow this channel to 100,000 subscribers. We don't know when we are going to be getting there, but we will get there anyway, because we want to make sure we reach as many students as possible. Ben Elise on Facebook said, thank you for the good work. Always a pleasure, Ben, and thank you for joining us today. So let's go there. After we do the initial measurement, so when we get the initial cost, what's the double entry? We're going to debit property, plant, and equipment. You know that already. And then we'll credit whatever cash or payables if it is outstanding, or whatever it is. That's all. So that is our double entry for the initial measurement. Very sweet, simple, straight to the point. Then let's go to the subsequent measurement. You with me? Let's go. Subsequent measurement. Now, this is where the journey begins to get interesting, and this is where students begins to mess up. This is where students begin to mess up. So you want to make sure you stay with me carefully on this one, because I'm going to be dropping a lot of nuggets here that will save you in the exam. So please make sure you stay with me very carefully here. And IAS 16 is a fundamental standard. It's a fundamental standard. Now, on subsequent measurement, IAS 16 states that there are two key modules that can be used to account for the assets. So either the entity is using the cost module or the revaluation model. So it is either we are looking at the cost module or the revaluation model. With the cost module, what is happening is that the asset is carried at its historical cost. So we carry the asset at its historical cost. Now, when we say we are carrying the asset at its historical cost, it simply means that we are carrying the asset at the initially recognized amount. It means we are carrying the asset at the cost at which we initially recognize it, or the cost at which we initially bought the asset. That is what we mean by the historical cost. The historical cost. Under the cost module also, what it then means is that the carrying value or the carrying amount of the asset will be equal to the cost of the asset minus any accumulated depreciation or impairment. Minus any accumulated depreciation or impairment. So the carrying amount of our assets will be the cost. Why is the cost? Because the cost is the historical cost, and we are using the cost module in relation to that. So with the cost module, the asset is carried at its historical cost, and the carrying value is going to be the cost minus the accumulated depreciation or impairment. But not only that, stay with me carefully here. When it comes to the revaluation model, it is where the asset is carried at the fair value. So sometimes the revaluation model is also referred to as the fair value. So it is where the asset is carried at the fair value or at a revalued amount. Now, what is the fair value of an asset? What is the fair value, or what is fair value? Generally, fair value is simply the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. Fair value is simply the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. Between market participants in an arm's length transaction. That is the fair value module. So, or that is fair value. So when we say the fair value of an asset, we mean how much we could get right now if we sell the assets. How much we could get right now if we sell the assets. So under the revaluation model, the asset is carried at the fair value. Then in that case, what's going to happen is that the carrying amount or the carrying value will be equal to the fair value minus any accumulated depreciation or impairment. The fair value minus any accumulated depreciation or impairment. But the big question we ask ourselves is, at what point can an entity use what? Please note that irrespective of the method that the entity chooses to use, the standard requires that the entity revalue the assets at least once a year. So NB, the entity is required to revalue its assets at least once a year. The entity is required to revalue its assets at least once a year. That is very, very critical. That cannot be overemphasized. That is very, very critical. So at the end of the day, now, why is that important? That is important because assets cannot be carried over their recoverable amounts. Assets cannot be carried over their recoverable amount. So I've made two statements so far under the notes. I said, number one, entities must revalue their assets at least once a year. Entities must revalue their assets at least once a year. And then number two, the reason why we are revaluing the assets is because of the fact that assets cannot be carried over their recoverable amounts. This is where IAS 36 comes to town, impairment of assets. And we'll get into that in a moment. Now, I see a question coming from Osmanu saying, Mr. Nhyira, please elaborate on what time depreciation to be charged on revalued amount, the transfer needed. We'll come to that. I'm not there yet, so stay with me. We'll come there in a moment. So when can we use the cost module and when can we use the revaluation module? Number one, if the asset has no ready market, in other words, if it is difficult to estimate or determine the fair value of the assets, then the asset shall be carried under the cost module. In other words, the asset shall be carried on subsequent measurements at its historical cost. Let me state that again. Where an asset's fair value cannot be determined, then the asset should be carried at its historical cost as per the cost module. However, when an entity can determine the fair value of the assets, then we can use the revaluation model. Now, to determine the fair value of an asset, we have to be in an active market, meaning there have to be buyers, there have to be sellers of that particular asset. In that case, there have to be buyers, there have to be sellers of that particular asset in that case. So if we can determine the recoverable amount of the fair value of the asset, use the revaluation model. If we cannot determine the fair value of the asset, then we carry the asset at its historical cost, so the cost model. Number two, if the asset requires modification before it can be used by other parties, in other words, the asset is of a specialized nature, then the asset shall be carried at its historical cost. Let's state that again. Where the asset will require modification before it can be used by other entities, that is, the asset is of a specialized nature, then the asset shall be carried at its historical cost, less any depreciation or impairments. Less any depreciation or impairment. Because it's of a specialized nature. It's a software customized for us. It's a software that no other company can use. It's a product that we've developed that nobody else can use. So in that case, we have to carry it at what? The cost module, because maybe it's not that easy to just determine the fair value of the asset. So that is what you need to understand when it comes to dealing with the issue about the cost module and then the revaluation model. Now, throughout this discussion or under the subsequent measurement, we are seeing that two things are popping up: impairment and depreciation. Impairment and depreciation. So let's spend some time real quick. And I see some of you guys joining. You are welcome. Comment in the chat box any questions you have for me. If there is something that I explained or that I said you are writing that you did not get, please indicate in the chat box on YouTube or in the comment section on Facebook, and I'm going to be taking them for you and also answering all of them in that case. And remember to share the video as well. Let's reach as many students as possible, and give us a thumbs up if you're just joining and you're getting some value here. So let's go. Depreciation. Now, if you're a follower of my work, you know that when I'm talking about depreciation, I don't just talk about depreciation, because depreciation, there are four things you must know about. There is depreciation, there is impairment, there is depletion, and there is amortization. Okay, and you must know these four things, and off head, you must know them off head. As a good financial accountant, or as a good corporate reporting student or financial reporting student, you must know this very well in relation to that. Now, depreciation is simply the allocation of the cost of the asset over its useful life, or depreciation can also be seen as the portion of the assets consumed during the year under consideration. Portion of the assets consumed during the year under consideration. Or, like I said, it has to do with the allocation of the cost of the asset over its economic useful life. Amortization is also allocation of the cost of the asset over its useful life. However, the difference is that depreciation works with tangible non-current assets, whilst amortization works with intangible assets. Are you getting the idea? So they are all about allocation of the cost of the asset over its life, or the consumption of the asset in the year under review. But depreciation is for tangible assets, amortization is for intangible assets. Impairment simply has to do with the fall in value of an asset. So we say that an asset is impaired when the carrying amount is greater than the fair value, the recoverable amount. When the carrying amount is greater than the recoverable amount, we say an asset has suffered an impairment. So impairment is simply the fall in value of an asset. And we will talk about that later on under IAS 36, because remember, we have IAS 36 as part of the issues we need to talk about. Depletion, on the other hand, is simply the fall in value of assets as a result of usually time, usage, natural disaster, and other factors. So when we say an asset has depleted, it means that it has fallen in value because of its age, it has fallen in value because of its usage, it has fallen in value because of natural disaster. That means that the asset is depleted. Usually, when you're talking about depletion of an asset, there is an impairment coming in that case. So they looks like they are closely related in that regard. But hey, my focus is not on them now. We will look at them later on. Let's talk about depreciation real quick. Now, when it comes to depreciation, there are various methods of depreciation that you must know about. But for the purpose of our examination, at least these three must be known in relation to that. These three must be known in relation to that. Number one, we have the straight line method. Number two, we have the reducing balance method. And number three, we have the sum of year digits method. Usually, these are the three that you must know offhand as a student going into the financial reporting exams or the corporate reporting exam. Okay, so I see some comments coming in. On Facebook, Mame Ajwa Achre said, thank you. You are welcome, Mame. Derek Achina Branchio, forgive me if I don't mention your name right, okay? Achina Branchio said, you have made it simple. Thank you, Derek. On YouTube, Glory Tete said, hi, Nhyira. Hello, Glory. I hope you're doing well. Thanks for joining us. Moses Koroma said, hello, sir. Please, how to determine the fair value of assets before using the fair value model? Oh, you are asking how do we determine the fair value of an asset? Like I said, the fair value model is used when we can determine the fair value of an asset, meaning there has to be an active market for the sale and these purchases of that particular asset. So if there is an active market available, then we can use that market to determine the value of the asset. Hence, we will say, hey, if this asset is being bought right now, what will be the price of it? So if it is easy to determine the fair value, so usually estate agents will be invited in, or some valuers will be invited in to come and value the assets in that case. So that is how we determine the fair value usually of an asset. So let's explain this concept real quick. Straight line method. So when it comes to the straight line method, what happens here is that simply means that we are calculating depreciation, or it's a method of depreciation where depreciation is calculated taking into consideration the number of years or the economic useful life of the asset. The economic useful life of the asset. In other words, under the straight line method, the same amount of depreciation is charged over the life of the asset, over the economic useful life of the assets. For that reason, what happens is that the depreciation calculated, it's going to be equal to either the cost of the asset minus any scrap value divided by the economic useful life of the asset. That is the annual depreciation chargeable. If you are looking at the depreciation and it is not per annum, then we bring in X over 12 to deal with the pro rata basis on a 1 month ownership basis in that case. So if it is a year, we deal with that. If it is not a year, we don't look at that. We bring in the X over 12 in there. The X simply means how long we are dealing with over 12 in that case. But one thing you must also understand is that when we talk about issues in relation to straight line method, it is also means that we calculate the depreciation on the cost of us, on the cost of the asset. We calculate depreciation on the cost of the asset. Why is that important? Because sometimes the examiner will not give you economic useful life of the asset. Instead, he would just say 20% straight line. So in that case, what happens is that your depreciation will be equal to, that is the depreciation calculated will be equal to the cost of the asset minus whatever percentage of depreciation given to you in the question, and that gives you the annual depreciation. Then if we are going to be taking into consideration the 1 month ownership, then the x over 12 is going to be coming in there. The x over 12 will come in there. So that is the idea about a straight line method. The same amount of depreciation is charged over the useful life of the assets. The depreciation is going to be the cost minus the scrap value. If there is no scrap value, no P, you just go ahead with your question. You divide it by the economic useful life of the assets. Then if it is less than a year, x over 12 is going to be coming in there. But note also that with a straight line method, depreciation can be charged on the cost of the asset, on the cost of the asset. I see some comments coming in. Isaac Indioba on Facebook said, please say, why is research fees not added to the cost of an asset? Research, in accordance with IAS 37, IAS 38, impairment of assets, IAS 38, impairment of assets, research expenses shall be written off as incurred. However, capital expenditure incurred in research shall be capitalized and amortized or depreciated over the economic useful life. That's it. So because research expenses, you can't get anything out of research. When you do research, you are not guaranteed that you use that information for anything. Because remember, something is recognized as an asset because we will get some future benefits from it. But if you just have a research and you have the research reports, it's meaningless. Unless we develop it into something, it's meaninless. That is why research expenses will not be included in the cost of the asset. However, it should be written off. But if in the research we incur any cost on capital expenditure, then those shall be capitalized and amortized over the economic useful life of the asset. So Isaac Indioba, that is how we deal with the research expenses as per IAS 38. Okay, that's as per IAS 38. Then John Malongo said, when you say amortized cost, what it means in prospect of financial reporting? I have with the word, and I don't understand the statement you are making. Maybe you can restate your questions clearly or your statement clearly, then I can understand what you are saying here. Mavis Ameto said, good evening, sir. Good evening, Mavis Ameto. How are you doing? Dan Ebo said, thanks for doing a great job. Always a pleasure, Dan Ebo. Welcome to the stream. So that's the straight line method. You can see very simple, sweet, straight to the point. Then we come to the reducing balance method. Reducing balance method. Now, when it comes to the reducing balance method, it is where depreciation is calculated on the carrying amount of the asset. So here, depreciation is calculated on the carrying amount or the carrying value of the assets. Okay? The carrying amount or the carrying value of the asset. What does that mean then? It means that depreciation calculated reduces as the asset ages. So the depreciation amount reduces as the asset ages. As the asset ages. So what does that mean then? It means that the depreciation chargeable will be equal to the carrying value multiplied by the percentage of depreciation. Then if you are dealing with a 1 year ownership or the pro rata basis, you're going to pull up x over 12 in relation to that. You're going to pull up x over 12. So that is the reducing balance method. We're calculating the depreciation on the carrying value of the asset, on the carrying value of the assets. Then we look at the last one, the sum of year debts. Sum of years decades. You see, the sum of year decades is just like the reducing balance basis, but this time around, we are going to be taking the number of years of the asset into consideration. What does that mean? The sum of year decades is simply going to be n out, n plus 1 divided by 2. What does that mean? There is a way this technique actually works, but let me just pull up a simple scenario, then you see exactly what we're talking about. So let's say that KK Limited bought an asset at, or let's say on 1st June 20x6 for $20,000. Let's say that the economic useful life on the asset is 5 years. Stay with me carefully here. And then we are preparing the account for the year ended 31st December 20x8. Okay, 31st December 20x8. So what do? How do we get the carrying amount of the asset for the 31st December 20x8? And I'm going to use all the methods to give you an idea of what exactly is going on there. So KK Limited bought an asset on 1st January 20x6 for 200,000. It looks like I like the zeros a lot. Let's just make it 20,000. And economic useful life is what? 5 years in relation to that. So what do? Sum of year decades. Okay, sum of year decades. So if you are doing the sum of year decades, the way you present this is very simple. You can put the year up like this. Then you could put the cost of the asset up like that. Then you could put the depreciation amount coming in there. What do I mean? So you're going to have 1, 2, 3, 4, 5, like this. Okay. So we're going to have cost or carrying value here. Then you add it up. You add it up. Now, if you add it up, what do you get? 2 plus 3, blah, 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 blah. I think that should be 14. I don't know if I'm right. No, 15. Am I right on 15? Yes, I should be right on 15, you know. 630 divided by 2. Yeah, 15. Now, so you could work this way and get your 15, or you could use the formula, the sum of year decades formula. Now, N here is simply the economic useful life of the assets. The economic useful life of the assets. So in this context that the asset has a 5 years, so the sum of year decades will be equal to 5 out, 5 plus 1 over 2. So that is going to also be what? 15. So you could use the formula to arrive at your 15, or you could use this structure to arrive at the 15. Okay, I see some comments coming in. Let me look at them. Mavis Ameto said, please, I want you to help me with a consolidated question. Mavis, unfortunately, my timing availability cannot enable me to solve a whole question with you because of what I have on my table. So if there's a specific treatment, you could ask a question about it, and you could be assisted on that via our WhatsApp line. But saying that I should solve a whole question with you, that would be really impossible for me in that case. But Anjum said, sir, on the reducing balance, carrying value is arrived at after deducting depreciation before applying the percentage. Yes. Yes. So what happens is that's a good question there. So what happens is that we will bring the cost of the assets, all right? Then you're going to bring in any accumulated depreciation that we have. Okay? Then we are going to then get the carrying amount or the carrying value. So the depreciation is then charged on this particular carrying amount or carrying value. So that is the idea in that case. That's the idea in that case. So, but that is the answer to your question. John Malongo said, okay, Avoca Gedgesberg said, we appreciate your efforts, sir. Thanks a lot. Always a pleasure, Gedgesberg. John Malongo said, always when I met with the word, it confused me, amortized cost. I don't know where that is coming from, because amortized cost is about financial instruments that is under IFRS 9. If you are dealing with debt instruments are carried subsequently at amortized cost. Meaning that you're going to be bringing the opening balance, bringing the interest, bringing the payment, and get the closing balance or the carry forward value in that case. So amortized cost is actually a way for subsequent measurement of debt instruments, whether debt instrument that is an asset or debt instrument that is a liability, as per IFRS 9. Ahas Timothy said, good evening. Yes, Ahas, good evening. I hope that you're doing well. So let's go back to our question. Remember, we are preparing the account for the year 20x8. Now, so to put it in context, I could just say we started from 20x6. So this could be 20x6, 20x7, 20x8. So look at how it's going to be coming in. So in the year 1, we are having the assets to cost 20,000. So we pull that up. So how will the depreciation be calculated? We're going to reverse it. So the depreciation for the first year is going to be 5 over 15 times the 20,000. Are you getting the idea? 5 over 15 times the 20,000. Then we can get our carrying value here. So 5 over 15 times 20,000. And I'm getting, we are working to the nearest thousand. So that's about 6,667. Okay, so 6,667. That's the depreciation figure. So you take it out from the 20,000. Please confirm that as well. So I'm getting 13,333. So that's the current amount at the beginning of the first year. Now remember, we are preparing the account for 20x8. So our focus is on 20x8. So in the year 2, our carrying value will be 13,333. Now the depreciation in the year 2 is going to be 4 over 15 still by 20,000. Okay, 4 over 15 still by 20. So it's like you are getting the reciprocal. You're taking the reciprocal of that. So 4 over 15 times 20,000. And you see that we are getting 5,333. So the carrying amount 13,333 minus 5,333. It's 8,000 here. Then in the year 3, which is what we are interested in, that is 20x8. Maybe let me just pull this down a little. I'm getting 8,000 coming up. So in the year 3, we're going to have 3 over 15 still by 20,000. You know why we are having 3? Because we started with 5. Okay, then we came to 4. Now we are at 3. Okay, so that's going to be 3 over 15 by 20,000. And that's going to be 4,000. 4,000. So your carrying amount is now going to be what? 4,000. So for the year ended 20x8, if you are preparing the statement of profit or loss, we're going to be bringing in the depreciation. Remember, this is going to be an extract. We're going to bring in our depreciation, and that is what? 4,000. That's what we're talking about here. Then, if we are preparing statement of financial position, also an extract, under non-current assets, write that in full. Property, plant, and equipment, the carrying amount is 4,000. So that is how we deal with the sum of year digits. Now, if you look at it closely, you realize that the depreciation figure is reducing as the asset ages. The depreciation figure is reducing as the asset ages. And that is one key feature you need to understand when it comes to dealing with the sum of year digits. And so these are the three methods that you need to really, really understand how they are working with in that case. If we were using the straight line method, no P, the same amount of depreciation will be charged. So if the same question and we are using straight line method, what's going to happen is that I'll pull up my cost coming in, 20,000. Then we are in the third year. So I could do accumulated depreciation as at, let's say, 31st December 20x7. That will be 2 years because this is the cost at 1st January 20x6. So that's 2 years. So I'll do 20,000 over 5 times 2. Okay. So 20,000 divided by 5 times 2. That's 8,000. Then I get 16. No. I get 12,000. That's the carrying value or the carrying amount as at 31st December 20x7. Now, I'm not done because I need 20x8. So I bring in the depreciation for 20x8 for 31st December 20x8. And that will be on a straight line basis. So 20,000 divided by 5. That's 4,000. So I take it out. So I get 8,000 at the end of the year as the carrying value at 31st December 20x8. Now, somebody will ask, Nhyira, why didn't you do all the 3 years at once to get a carrying amount? The reason is that there is a trap. Sometimes when students do the whole 3 years here like that, they take that figure into the P&L account. But in the P&L account, we only bring the depreciation for the year under consideration and not the accumulated depreciation. I hope you are getting the idea. So we bring the depreciation for the year under review or for the year ended under review and not the accumulated depreciation. So many a times students will do the whole 3 years here, then they will get 12,000 and they will take that 12,000 to the P&L account. No, that is why I broke it into two so that I can get the depreciation for the actual year under review, review. So that is the idea about that. Any questions, please let me know if you have. So that is the next thing you need to understand about the subsequent measurement. Finally, on the subsequent measurement will be the revaluation of assets, treatment of revaluation. Now, like I mentioned, at least once a year, an asset should be revalued. Okay, at least once a year, an asset should be revalued by the company so that we will be able to know what is going on, because assets should not be carried over their recoverable amounts. When it happens that way, faithful representation is not met, and that is not a good thing for an organization. So when it comes to revaluation of assets, there are two things you need to understand. But before then, note that revaluation means comparing the fair value of the asset with the carrying amount. Comparing the fair value of the asset with the carrying amount or the carrying value. So we can have what is called the upward revaluation and then downward revaluation. Stay with me carefully here because there are a lot of principles I'm going to be unpacking here in that case. Now, if for the first time an entity value its assets, and we realize that the carrying amount it's less than the fair value of the assets, that results into an upward revaluation. In other words, if an entity revalue its assets and the carrying amount or the carrying value is less than the fair value, it means that that is going to lead us to a revaluation surplus. Or if you want, revaluation gain, revaluation surplus or revaluation gain. So the revaluation surplus or revaluation gain is arrived at when your fair value is greater than the carrying value or the carrying amount in that case. Please note that once an asset is revalued, depreciation shall be calculated on the revalued amount. Once an asset has been revalued, depreciation shall be calculated on the revalued amount. This happens whether we are getting downward revaluation or upward revaluation. So that is a note you must take care of the bets, that depreciation, it's calculated on the revalued amount. Depreciation is calculated on the revalued amount. So what happens here? Since there is an upward revaluation and we are going to be calculating the depreciation on the revalued amount, what happens usually is that the entity will charge a higher depreciation than it is supposed to have charged. Because maybe the carrying value of the asset is whatever, 10,000, but now the fair value of the asset is 15,000. So there is a revaluation surplus of 5,000, right? Now we have to calculate the depreciation on the fair value, the 15,000, and not on the 10,000. So when you do that, more depreciation will be charged to the P&L account than it's supposed to be charged. When that happens, it means that the profit of the organization is going to reduce. When profit reduces, it means amount of profit available to be distributed to the shareholders will also be reduced. If the amount of profit available to the or distributable to the shareholders will reduce, then we have to find a way to compensate them. So how do we compensate the shareholders? This is where we do an annual transfer. So the third thing you must understand is the transfers. The transfers. Now, when we say the transfers, what do we mean? The transfer simply means that we are transferring from the revaluation surplus account into the retained earnings. So we are compensating the shareholders for the reduction in the profit as a result of the upward revaluation of the assets. We are compensating shareholders for the reduction in the profit as a result of the upward revaluation of the asset. So we make an annual transfer. How do we get the annual transfer? The annual transfer, AT, is equal to the revaluation surplus or the revaluation gain we get in divided by the remaining useful life of the assets. The remaining economic useful life of the asset. You want to make sure that you pay attention to remaining. You want to make sure you pay attention to the remaining. So when we are making the annual transfer, we are transferring using the remaining economic useful life. How is the transfer done? Simple. We debit the P&L accounts, and then, did I say P&L? Sorry. Debit the revaluation surplus, debit the revaluation surplus, okay? Then we credit the retained earnings. So that now we've reversed that excess depreciation that was charged. We've reversed that excess depreciation that was charged. Okay, I'm seeing a question coming in from Timothy. He said, sir, please, if the revaluation is done at the end of the year, should we change the depreciation on the revalued amount or carrying amount? Should we? I think you are saying you are charging depreciation. No, you have to. Should we charge depreciation on the revalued amount or the carrying amount? If the, I'm not getting the context of your question, but stay with me. I think I have an idea of what exactly you're talking about here. So that is what we mean by the upward revaluation. So we compare the carrying value with the fair value. We are seeing that the carrying value of the amount is less than the fair value. So if the carrying value is less than the fair value, that means that we are going to be getting a revaluation surplus or revaluation gain. The standard states that depreciation should be charged on the revalued amount. Depreciation should be charged on the revalued amount. So if depreciation should be charged on the revalued amount, that means that we will charge more depreciation than we are supposed to have charged. For that reason, profit distributable to the equity shareholders will be reduced as a result of the excess depreciation coming in because of the revaluation of the assets. So as a way to compensate the shareholders, what do? We give them what they want by reversing the effect of the excess depreciation. How is that done? That is done by making transfers from the revaluation surplus to the retained earnings. How do you know how much to transfer from the revaluation surplus to the retained earnings? That is where we say that the annual transfer, that's where we say the annual transfer equals the revaluation surplus or the revaluation gain divided by the remaining useful life of the asset. And the double entry is going to be you debit the revaluation surplus to reduce it, meaning you subtract it from the revaluation surplus. Usually this will be done in the statement of changes in equity. Then you add it back to the retained earnings. The same figure is added back to retained earnings. But be careful here. Please be careful. Revaluation can be done either at the beginning of the year or during the year. Or it can be done at the end of the year. Please stay with me carefully. I think this is what Timothy was trying to talk about in relation to that. If the revaluation is done at the beginning of that year or during that year, then the depreciation for that year will be calculated taking into consideration what? The revalued amount. So for instance, if the revaluation is done at the beginning of the year, okay, the revaluation is done at the beginning of the year, what is going to be happening is that we will charge depreciation for that year using the revalued amount. Okay. However, if the depreciation is charged, if the revaluation is done during the year, then depreciation will be splitted into two. We will charge depreciation partly on the assets before the date of revaluation. Then after the date of revaluation for that year, we will charge the depreciation on the revalued amount again. So it means that the X over 12 concept is going to be coming in, the pro rata basis is going to be coming in. But if the revaluation is done at the end of the year, then we've already charged depreciation for that year. So it means any depreciation chargeable will be in the subsequent year. Because if the revaluation is done at the end of the year, you've already charged depreciation. In that case, when the revaluation is done in the year or at the end of the year, no transfers are made because you are not charging any depreciation. But if the depreciation is done at the beginning of the year or possibly during the year, transfers will be made from the revaluation surplus to the retained earnings. Any questions on this? Any questions on this? Osumano Amako said, with regards to the transfer, can we just find a difference between the depreciation on CA and the fair value depreciation. Yes, you can do that, but that is a long process. In the exam hall, you want to make sure that you are working with time. So if you get a carrying value to be 10,000 and you get a fair value to be 15,000, what you are saying here is that you calculate, and let's say the remaining life of the asset, it's whatever, 5 years, okay? So what you are saying here is that you calculate depreciation on the carrying value. So depreciation using the carrying value will be 10,000 over 5, and that's going to be 2,000. Then again, you calculate depreciation on the fair value. That will be 15,000 over 5, and that's going to be 3,000. So that the excess depreciation becomes the annual transfer. And that's going to be 1,000. Yeah, you can do that. But you're going to be spending time on this because you are calculating depreciation on the old asset, which you don't need for anything. So why not just take the revaluation gain, which is 5,000 here, which you'll be taking to the revaluation surplus any case, and just do annual transfer to be equal to 5,000 over 5, which will give you the 1,000. But any which way, whichever way you understand it, you can go by it. But remember that there are certain approaches, when you use them in the exam hall, they waste your time. They waste your time. And in the exam hall, one of the things you want to do is to make sure that you are as fast as possible with what you are doing and presenting your work to understand it very well. So yeah, you can take the excess depreciation, but you can also work with the revaluation surplus. Whichever way you are comfortable with, you go with that. But you have to take into consideration timing as well in the exam hall. Any other questions? Bring it up in that case. Kesi Kwekuban said, Mr. Nhyira, for assets like land, which usually depreciate in value yearly, how do we do an annual? No. Land is not depreciated, Kesi. Land is not depreciated. Land is not a depreciable asset. Okay, so there is nothing like annual transfer on land. That is a good question there. I love that. I love the question from Casey. So if you have land, I love that question. If you have land and building, okay, and there is an upward revaluation for both of them. So the land is having an upward revaluation, the building is having an upward revaluation as well. Note that because land is not a depreciable asset, the annual transfer shall only be made on the depreciation, the building. The annual transfer shall only be made in respect of the building because it is the building that will be bringing in the excess depreciation, not the land. Not the land. So, Cassie, that is the idea there. Yes, land will increase in value, but because land is not a depreciable asset, the transfer will only be made in respect of depreciable assets. So only the building, which is what we are going to be taking into consideration in that case. So that is a good question there. It's a critical concept that many students flip with, and many students actually get wrong when it comes to the treatment of this. So the land, the revaluation surplus for the land, you don't do transfer in respect of that because you don't depreciate land. It is only the building that you would have to take into consideration in that case. Timothy A has said, thanks, sir, you are welcome. Dennis February said, Nhyira, take that again on treatment of depreciation of revaluation during the year. Okay. I said, if during the year the entity revalue the assets, it means two things is happening. So let's say the year ended for the company, it's, let's just bring something up. 30th September. Let's say that's the year ended of the company. Okay. So let's say that they did a revaluation on 1st July of that year, which means that now the asset has been used, will be used, the revalued amount will calculate depreciation using the revalued amount for February, July, August, and September, 3 months. So that's going to be 3 over 12 multiplied by whatever we have for the depreciation. However, the asset has been used before that time. So from 1st October the previous year to 30th June, which is going to be 7 months, we're going to be calculating the depreciation using the carrying amount or that initial cost coming in there. So when we finish, the two results will be added to get the depreciation amount in relation to that. So Dennis, I don't know if you got that well. That was what you wanted me to talk about. So that is how we deal with it. That's how we deal with it. So if the revaluation is done during the year, two depreciations will be calculated. One will be calculated in respect of the carrying amount from the start of the year till the date the revaluation was done. Then after the date revaluation was done, we will use the revalued amount to calculate the depreciation, taking into consideration the number of periods. Taking into consideration the number of periods. Esiedu Kweku said, I'm enjoying the lesson. Thanks, Nhyira. Always a pleasure, Esiedu. Apieje Kweku said, Nhyira, will the excess revaluation of the land goes to the revaluation surplus? Yes, definitely it will go. It will go to the revaluation surplus. It is just the transfer in respect of it that we don't take there. It is just the transfer in respect of this, in respect of it that we don't do. But the amount with the building will still end up in the revaluation surplus. So yes, it will be taken there. Any other questions? Dennis, if you are on, let me know if what you asked has been answered for you in relation to that. Then, still on the revaluation of the assets, is to deal with issues about deferred tax. Upward revaluation, okay? To deal with issues about deferred tax. That's about IAS 12. You see, that is why I tell you that the standards are interrelated and you have to learn them like that. That is why financial reporting and corporate reporting, it's so interesting and so loving that if you understand it, when you sleep cry, you'll be dreaming about the standards. And it makes it very nice. And it makes it very nice in that case. So there is a deferred tax effect when there is revaluation of assets. What do we mean by that? What do we mean by that? Deferred tax comes in by comparing the tax base or the written down value of the assets with the carrying value or the fair value of the assets. So when an asset is revalued, the tax authority, they don't know about revaluation. You did your revaluation and you got the revaluation surplus. So what happens is that deferred tax must be calculated on the revaluation gain. And that revaluation gain, the deferred tax, would go to the other comprehensive income. Make sense? Very, very sweet, simple, straight to the point. Very, very sweet, simple, straight to the point. So there could be a deferred tax issue on the revaluation surplus. And that deferred tax you are calculating on the revaluation surplus should be taken to the other comprehensive income. Okay, because when you compare the tax base with the fair value, you're going to get a taxable temporary difference. So the temporary difference, the taxable temporary difference, will be the fair value minus the tax written down value. So the figure you get, your deferred tax, will be equal to the taxable temporary difference multiplied by the tax rate. And that figure you get, usually, it's going to be going into the OCI. It's going to be going to the OCI. But there is a way it has to be splitted. Sometimes not all the deferred tax will go to OCI, but the one that goes to the OCI is in respect to the revaluation gain. and then any excess will be taken to the P&L. I'm going to pick a question on this possibly tomorrow to explain this concept very well, because it's an interesting concept. But if, for instance, I'm referring to the illustration I used here, what it means is that if the revaluation gain is 5,000, like we did here, if the revaluation gain is 5,000 and the tax rate is 30%, all we would do is the deferred tax is going to be what, 5,000 times 30%, and that's going to be 1,500. Okay, and double entry for that is to debit the other comprehensive income with the 1,005, and then we will credit deferred tax in the statement of financial position 1,500 in that case. And that is it. That is it. So that treatment, we will go to the issue in relation to the OCI. Now, when we say you are debiting the OCI, it means you credit it. Sorry, it means you deduct it. So if I go to the OCI, I'll bring in the revaluation surplus of 5,000. Then I'll bring in the deferred tax of 1,500, like this. That's what we mean. So in the OCI, the gain will come there, then the tax on the gain will also be treated there. That is what you need to understand when we deal with upward revaluation. Upward revaluation. Osumanu said, why should the examiner give us that headache? Which headache is that one? Osumanu, which headache is that one you are referring to? So that is the idea about that. Dennis said, yes, Claire, please. Okay, that's awesome. Mavis Ameto said, please, how do we calculate impairment provision of an asset? When you say impairment provision, what do you mean? Because there is nothing like impairment provision or Mavis. So maybe restate what exactly you want to get so that I can provide you with a better understanding in that case. So that is upward revaluation. Make sense? Upward revaluation. Upward revaluation. Now, because of time constraints, I'm going to be ending around here today. And God willing, tomorrow we will continue with the downward revaluation. Then I will explain to you the rest of the concepts. Then we pick some questions up under these 4 standards, and then we look at them. So you realize that IAS 12 is coming in IAS 16. IAS 36 is finding itself there somewhere. We will look at that. Then IAS... we talk about the issue in relation to borrowing cost also coming in the concept in that case. So these are some of the things you need to understand. And like I said, because of time constraints, I need to conclude around here because our public sector class is in just 8 minutes. Can you imagine that? Just 8 minutes. And I need to just quickly bring them on in that case. So thank you very much for joining the stream. It's been a great session with you guys today. God willing, tomorrow at 4:30 p.m., I'm going to be continuing with this to look at the downward revaluation and again unpack some key principles that you need to understand and how the application is actually done in the financial statement. Then we will be going to pick some questions up to see how these pieces actually add up together in relation to that. Osumano said, deferred tax treatment or revaluation loss. Headache during the year revalued. I don't get that. I don't get that. APJ said, please, the slides on deferred tax. Okay, so let me go back and share my screen on that. Okay, so APJ, the slides on deferred tax, where is that? Yeah, this one is what you are referring to. Is that a slide on deferred tax? Yeah. So APJ, this is it. John Malongo is asking, how deferred tax comes in PPE? Come again on that, sir. We said deferred tax is coming in because an entity is revaluing its assets. And according to IAS 12, when you are accounting for transactions, you must account for their tax consequences as well. So in accordance with IAS 12, any transaction the entity is accounting for, it must also account for the tax consequences of that particular transaction. So if you are finding out why we are dealing with the deferred tax, it's because now you've revalued your asset, which means if you sell the asset today, you will sell it more than how much you have sold. You are supposed to have sold it at the carrying amount. Because of that, there will be future tax consequences. On that, you must either pay tax to get a taxable temporary difference or get a tax relief, and that will be a deductible tax difference. So the reason why we are bringing on deferred tax on the PPE, it's because you are revaluing the assets. So if you revalue the assets, then the tax effect on the assets will also be subject to some change, and that must be considered in the preparation of the financial statements. Apia, I hope that you got what you wanted from this slide here so that I can run out. Okay, but Bart said at Malongo, I think it's because of the revaluation. Yeah, it's because you are revaluing the assets. That is why the deferred tax is coming in there in relation to that. So that is it basically about that. And thank you very much for joining the stream today. It's always a pleasure coming your way. Remember to join me same time tomorrow as we continue with these sessions. I want to provide you with the strategies you need. I want to provide you with the key principles you must understand in order for you to actually prepare well for the exams, and most importantly, pass the exams in that case. So thank you very much for joining me. And thank you guys for the thumbs up on the video. Those of you who shared the video, thank you very much for your support. I really appreciate it. And thank you for subscribing also and joining us. Continue to be connected with us. We're looking at how excited some of these sessions will be. If some of these sessions, I get really excited about it based on the engagement, maybe we could host some Zoom sessions that you guys will come on with me. Then you can talk to me and I assist you in order for you to prepare well for the exam. So let's see how it goes. Join me same time tomorrow at 4:30 p.m. Remember to follow me on Instagram if you have not followed me on Instagram, because the discussion for the day will be posted there and you will be able to get the notice about what it is we want to discuss, so you make time to join in that case. Take care of yourself, stay safe, and stay blessed. Bye-bye.